This is Golden Years, a roadmap to navigate retirement with Mark Cordner, the podcast.
All right, Mark, when that check engine light comes on, how long do you usually wait before you make that painful drive to the mechanic? What do you think?
Well, if it's my wife, I'm hoping it's immediate. I'm hoping that she'll speak up because the bill is always far more expensive the longer we wait. There's things in life that we don't want to deal with. I often use the example of the medical doctors. You know, I'm kind of like a financial doctor in the sense that I very much have advanced education in this area. And I've spent 30 plus years focusing on things that most normal people don't want to focus on. But meeting with me requires people to open up.
Yeah, they have to be immediate too.
Yeah, we've got to share things we don't want to share, you know. And I've said that, you know, if I go to a doctor, I've got to be willing to strip down and let them do an inspection, as it were. And I'm not comfortable with that. I remember a dear friend of my wife and mine he became a OBGYN, and we met him again after, you know, some years after college, and he said, you know, you ought to come to me, kind of thing, to my wife. And she looked at me afterwards and she says, never going to happen. I'm
never going to happen. No
never going to go to a friend for that.
No,
and,
no.
You know, it's maybe an inappropriate example, but the point is it's intimidating. These things are intimidating. We're putting ourselves at the mercy of people, and we don't know if they're going to take advantage of us. I mean, I definitely fear that with mechanics because I don't know a clue about automobiles or things with my hands. And I've definitely been taken advantage of before. And so there's that fear factor with financial advisors.
Exactly. Yeah, you have to deal with things. I mean, you're intimidated. It's not your wheelhouse, not something you do every single day. And just if you're wondering what's the average time that people wait to finally get to the mechanic, Hyundai did a survey. They found out it was actually 9 days. I'm very much like you, Mark. The minute I see it on, I'm going that day or the very next day. I do know folks that just drive and hope the light just disappears somehow because they don't want to deal with it. But you know, you're exactly right. There are certain things in life you have to kind of hit head on, and you know, talking about your finances, and that goes for if you're 40, 50, 60, or if you're, you know, on that bridge of 65, 70 to retirement. I mean, this is a conversation you have to have, and I think, you know, just as important it is to make plans to go on that family trip or that big cruise or the family reunion or whatever it is, you have to put, oh my gosh, just put a quarter of that energy into your financial planning. Would you agree?
Oh, yeah. We joke in the business about how people spend more time planning a 2-week vacation than they do a 20, 30-year retirement.
Oh, yeah.
And I honestly find that true. They'll often come to us last minute, you know, the day before. A great story. I had a client who actually walked into the office this morning. They got to retirement, and they called me afterwards. And for years, they had kind of threatened to come visit with me. And they called me, and they said, hey, we'd like to come visit. We just retired. And I said, well, you know, what prompted that? That'd be great. You know, what prompted the retirement? He said, well, I turned 65. And I said, oh, okay. Well, happy belated birthday. Come on in. And so long story short is they hit that magical age and they retired, and it turned out they had like $21,000 saved. And you know, I didn't have a magic wand where I could, you know, make that extend for years. And I don't want to get too personal here, but their circumstances were such that they ended up, you know, later declaring, this was around the time of the Great Recession, and they ended up declaring bankruptcy, and they've been renters since, and so on. But, you know, he wasn't able to go back to work at that time and in his particular field. And so there's a scenario where had we met in those 10, 15 years prior where they kept threatening to come visit with me about it, we could have helped them. And this is an extreme example to use them, but I say it solely to exaggerate the point that the earlier we deal with issues, most any issue in life, frankly, the better off we're going to be, the better prepared we're going to be. And so we want to get people in early and start these conversations so that there's no surprises, or there's as few surprises as possible, because success is really what it's about. I love the story told by Ken Dykewald. He's perhaps the most famous gerontologist in the world. He studied baby boomers for the last 40, 50 years. He is a baby boomer. And he talked in one of his recent books about how the baby boom generation desired to change the world when they were younger, back in the 70s. And now they're in a period of life as they approach and enter retirement where they literally can change the world if they're willing to do it. They have the most means and they have the most time. And I point this example out because it's not entirely about means. Certainly financial means make things easier, but there's ways we can change the world one person at a time. And I say God bless the retirees who volunteer and staff the nonprofits in the world, because they're the lifeblood of these nonprofits. So we have to have our basic needs met. So let's make sure we deal with someone, we get the outside help we need to make sure things are structured properly. And I use that word consciously, structured properly, so that we don't run out of money, so that we have the dignity we need. And then after that, if money is needed to accomplish our dreams or not, is entirely up to us. Some people are totally fine volunteering and walking the neighborhood. And I have a son, if he could spend the rest of his life just walking his dog, he'd be totally happy. And so there's people like that. It's not about money for everyone,
right?
But money is the fuel we need. And so if we want to get to our end destination, before you enter the Mojave Desert, you better dang well make sure you got enough water and you got enough fuel to get to the next service station.
That's right.
And I can tell you some crazy stories about that, but yeah, come visit with us. Don't leave it to chance is really our message to people. Get an outside perspective. Let's get the structures in place as needed. Let's do the work up front so that you can go live your life in the most significant way possible for you, however you define that.
And it all begins with that discovery visit, seeing exactly, okay, what are you working with? Where are you trying to go? What's the best vehicle? We've talked about it before, planes, trains, and automobiles. There's lots of different vehicles to get you to your final destination of retirement. Let's figure out which one works best for you. That discovery visit is complimentary. 702-996-4050. That's 702-996-4050. The website, of course, mygoldenyearsroadmap.com. And, you talked about having enough income and the number one fear being running out of money. Well, we've heard you say before that nobody should put all their nest egg into an annuity. So the next question is, of course, how much should somebody put in an annuity to provide a stream of guaranteed income, and what could it cover? Well, Cheryl Moore, she's an annuity advocate with winkintel.com. This is what she says.
I would say the least amount that you should be considering putting into the annuity would be the amount that you need to cover all your expenses, or that income floor that you have. That's a good rule of thumb to use as the minimum amount that you should put into an annuity.
So what are your thoughts on this? Do you agree, disagree?
Oh, I agree. I think Cheryl's very wise in what she's saying there. And there's different kinds of annuities. There's different kinds of structured forms of income. But the basic idea of identifying what your floor is, I call it your dignity level. What's the basic income you need to cover your basic expenses? That should be addressed in some form of assured lifetime income. And annuities have become so popular again. It's interesting. In my first 20 years in the business, a lot of people were kind of poo-pooing annuities because the stock market was so sexy that that's where they wanted to focus their energies. But now we've seen this total swing back to where, annuities were so popular in prior generations, and now their virtues are really being held. And so we have people coming to us who want more information about this. I've come to love annuities. They are not the only place to put all your money, but they are a tremendous tool. We need to be diversified, and just like any other vehicle, planes, trains, automobiles, they each serve their own purpose. And so I agree with Cheryl that one primary reason for an annuity is to assure basic income. It's that dignity assurance, or dignity insurance, may be a way of putting that. But the other thing that some kinds of annuities do extremely well is help us to de-risk our portfolio. And what I mean by de-risking the portfolio is every portfolio has a certain degree of volatility, ups and downs, and potentials for losses that we need to be aware of. And a lot of people, frankly, are not aware. They haven't done any kind of x-ray of their portfolio, as it were, to analyze it. But interestingly, we can introduce annuities into a portfolio, often, for example, as a bond alternative, and we can provide a measure of principal protection, meaning complete safety of that original seed money that you put in, and a locking in, as it were, of the gains, so that there's the assurance that on at least a portion of your money, you're never going to go backwards. And so all of this, of course, depends on the claims payability of the insurance company and all the normal disclosures that we would give. But candidly, the insurance companies are frankly 10 times safer than the banks for reasons I can detail later. But
basically what you're saying, if I just recap it here, so basically those principal protections coming in with an annuity means, okay, here's the deal. We're going to be able to capitalize when the market goes up, and you're going to get those gains. If the market goes down, guess what? You are going to be protected. You're not going to lose anything.
Correct. With the most popular type of annuities, that's absolutely correct. The other thing to remember is, frankly, the insurance companies will not let you put more than roughly 2/3 of your assets into annuities. They want you to keep, and this is a problem, frankly, I've been struggling with this week, as I keep having insurance companies tell me, disagreeing with the client's desire to put larger portions of their money into annuities.
Oh, wow.
The insurance companies want you to have a certain degree of liquidity. And most annuities have some type of liquidity restrictions on them, at least in the early years. And so the insurance companies are hypersensitive to this fact. They also believe in diversification. They believe that some money should be totally accessible or liquid, as we say, and available. And so, yes, we never put all of a person's money in. At most, we would put 2/3 of their money in, but the percentage really depends on the client's objectives. And the real question is, how much of your money do you no longer want to leave to the vagaries of the market? How much of your money do you no longer want to leave at risk of loss within the market? And so if we're talking about fixed annuities or fixed index annuities, then there are certain assurances that we can give people that can bring tremendous, sleep insurance, as you sometimes call it. It's that ability to not worry. And so the invitation I always give people is come visit with us. I believe strongly in what's called a two-pocket approach, meaning that when the market's down, you need to have a pocket into which you can reach that is not going to be affected by market downturns. And when the market's back up, then we reach back into the market-based pocket and we enjoy those upswings in the market. But we need to have more than one pocket in our financial lives so we can reach into the various pockets that exist within our portfolio to be able to respond to whatever life brings to us. And if you don't know how to do this, then please come visit with us. We can share some ideas with you and show you how to not only decrease the risk in your portfolio, but counterintuitively increase the returns often at the same time as a result of never having to recover from losses, because in these strategies, you're not experiencing losses. So come visit with us. We can show you how all these things work.
There was an article from Kiplinger that mentioned the old saying, it's not what you earn, it's what you keep. And that definitely relates to taxes. So when you look at the biggest expense in retirement, taxes are often overlooked because many think that they can't change what they owe. It is what it is. Uncle Sam says this is it. But there's actually a good tax strategy that can show otherwise. So, Mark, talk me through this.
Oh, I may have to restrain myself on this because this is a favorite topic. I mean, the truth is that most people don't think consciously of taxes. It's something that we want to mentally avoid. But the reality is many people approach retirement with this unfounded belief that they're going to somehow be paying less, because for the last 50 years, Wall Street has been perpetuating this idea that we're all going to retire with less income and therefore we'll be in a lower tax bracket. And the truth for many retirees is that's not the case. They may well have more income than they had during their working years, or they may simply have lost, for example, their favorite tax deductions, things like the mortgage interest deduction that they were accustomed to, the benefits of having children in their home. Now it's grandchildren and the government doesn't give you a break for that. They may have given a lot of money towards charities during their working years, and they're not giving as much money to charities. They're giving time instead. And what does the IRS think of your time? Well, nothing.
Nothing.
They don't want anything of your time. And, we're not contributing to our retirement plans, our 401ks and all this in retirement. So some of these deductions that were our best friends throughout our working years kind of vanish away in retirement. And people find themselves, strangely enough, paying more taxes sometimes in retirement than they ever anticipated. And really what it boils down to is groceries. And people think I'm sometimes trying to exaggerate this, and I'm not. I mean, the last couple years of rampant inflation has made stunningly clear to most of us that stupidity on the government's part, certain government behaviors can put us in situations like this rampant inflation that suddenly make groceries twice as expensive. Or if we're going into retirement with a limited income and suddenly they start raising tax rates for reasons related to historical spending patterns, for example, the government may be forced to increase tax rates in retirement, and suddenly we're able to keep less of what we thought we had earned. And so this is actually a really, really, really big deal. And so we've got to get clear on our beliefs about taxes. Do we believe, for example, that tax rates are going to go up? If we believe that, then are our behaviors, are our assets in alignment with that belief? Do we have most of our money in taxable accounts or perhaps in never before taxed, tax deferred IRAs, for example, because all that money is going to be taxed. The earnings on the taxable accounts and the tax-deferred IRAs, for example, that money is all going to be taxed when it comes out in the future. And that surprises many people. If we are going into what I absolutely believe is a rising tax environment, then we need to prepare ourselves for this. And so it boils down to a story I'd love to tell you. There's a story, and it may be apocryphal, I don't know, but it comes from Judge Learned Hand, who was an esteemed jurist on the federal tax courts, I believe back in New York. This was many decades ago. Judge Learned Hand, what a great name, Learned Hand. He had all these statements that first-year law students always learn in their first year of tax, the first weeks of tax law. And he says a number of things about how there's two sets of tax rules, one for the informed, one for the uninformed, and so on. But there's this story that may be apocryphal where he supposedly invited a clerk of his over to a window of his office, and he supposedly looked out this window, and there was this river there, and he pointed out that there was a bridge not far from their building that they could cross, and by paying a toll, they could get home very quickly. But then to illustrate, and what he was talking about was the difference between tax evasion and tax avoidance. To illustrate the concept, he said, look down the river. You notice this such and such other bridge a mile down the river. If we're willing to inconvenience ourselves, we can still get home without paying the toll tax. We can go to the second bridge and by inconveniencing ourselves, still get home. And so I jokingly say that this difference between tax avoidance, which is totally legal, that's the idea of inconveniencing ourselves and getting home in a kind of a roundabout way, versus tax avoidance, which is crashing through the toll gate. Unfortunately, that was lost on Wesley Snipes, and he ended up going to jail. Which is too bad because I love him as an actor.
It's true.
But tax avoidance is completely legal. Tax evasion is not. What we're talking about is legal strategies, legal means of getting off this train track, as it were, where there's a total crash, a mess coming up in the future. We can take steps to get off of that and avoid the increased taxes that are coming in the future. And at the end of the day, it's really about groceries. I find most people because they have too much money in taxable and tax-deferred accounts, they not only pay too much in income taxes, but they also end up paying in unexpected taxes on their Social Security benefits, in additional costs for their Medicare Part B premiums. And so what they believe, namely that taxes are going to go up, and what they're doing, which is having too much money in taxable and tax-deferred accounts, is at odds with each other. I often say this is like driving down the freeway with one foot on the brake and one on the gas. It makes for a bumpy ride. We're not being consistent. We need to get our actions and our philosophy in alignment and behave accordingly if we want to reduce taxes and actually have sufficient groceries in retirement. So don't leave this to chance. Come visit with us. If you have questions about how to legally avoid taxes in the future, there are absolutely strategies, for doing this legally. There are tools that you can take advantage of, but you have to act. You got to get ahead of the curve and act. And so come on in. We'll visit with you. We'd love to share some books and educational materials with you on these topics and help you understand that you have far more control over this situation than you may think you do.
Investment advisory services offered through Golden Years Financial LLC, a registered investment advisory firm. Insurance is offered through Golden Years Insurance Services. These firms do not provide legal or tax advice. Consult your own legal and tax advisors before taking actions that may have tax implications. Investing in securities involves risk, including the potential loss of principal. Insurance contracts' principal protection is based on the claim-paying ability of the respective insurer. None of the information contained on this website shall constitute an offer to sell or solicit to buy a security or insurance product. The information and opinions contained on this site or requested from this site are provided by third parties believed to be reliable, but accuracy and completeness cannot be guaranteed. They are provided for informational purposes only and are not a solicitation to buy or sell any of the products mentioned. Any media logos and/or trademarks contained herein are the property of their respective owners, and no endorsement by those owners of Mark Cordner, Golden Years Financial, or Golden Years Insurance is stated or implied.